periodic inventory has a problem. And its problem is this: it can't do beautiful financial statements unless you physically go out there and count your inventory. Because unless you physically count what's left, you really don't have a good number for what the cost is of the goods you've sold, because you've made no journal entries, have you? So what has happened over the years is we've come up with some methods for estimating ending inventory and cost of goods sold for the periodic method, and the method is called the gross margin method. Now, we use this during the period when we want to do beautiful financial statements, but we don't want to take a physical inventory. We also use this method, say, if I'm an insurance adjuster and the hurricane comes through town and you know that you lost it because it's not here anymore, but you have to estimate your loss. So many times they'll use the gross margin method to estimate the inventory damage or the inventory loss. So let's take a look at it. It says, same facts as before, we have beginning inventory, we have 2 purchases, we have available for sale or damage 15 units at a total amount of $32. That's its cost. Now, the gross margin method will tell you what you've recorded your sales for so far, and also what your gross margin percentage is. Now, would you say that sales is equal to 100% of sales, and that cost of goods sold is going to be a percentage of sales, and that gross margin is also going to be a percentage of sales? Now, it tells me in the problem that the gross margin percentage, based upon the last financial statements that I did where I physically took the inventory, was 40%. Well, if gross margin is 40%, then what is cost of goods sold as a percentage of sales? It's 60%. So, if that's the case, then if I want to figure out what cost of goods sold is, all I have to do is take, is it 40% or 60% of my sales? You're right, it's the cost of goods sold. 60% of your sales of $50, 60% of $50 is $30. So the cost of what we sell, we estimate to be $30. Well, if that's the case, then what do I estimate ending inventory to be? $2. So notice, by using this gross margin percentage and finding the cost of goods sold percentage, I can derive my best guess of what cost of goods sold is, so I can make those beautiful financial statements, and I can also estimate the cost of my ending inventory. Many times companies do this for what? Inventory losses, or they'll also do it to figure out if some stealing is going on, because if they don't come out with a quick count close to this ending inventory number, they know something is amiss. So, gross margin method of estimating periodic inventory.